Hello everyone, kia ora, bulavanaka, talo falava, bonjour, kia orana, hello Olketa, and a warm welcome to this Business Link Pacific webinar. My name is Barbara Wilkinson and I am BLP's Professional Development Advisor. One of my roles at BLP is to support business advisors with the skills they need to provide high quality advisory services. And so it's my pleasure to host this second webinar series which focuses on business advisor skills. In this series, we look at the range of skills and knowledge that business advisors need, and we share experiences on what it takes to be a business advisor. Last month, we looked at the legal knowledge that business advisors should have, and as you know, in today's webinar, we'll be looking at interpreting financial reports, a very important skill, not just for business advisors actually, but also for business owners, for directors, for managers, and board members. So consequently, we've opened this particular webinar up to businesses as well as to our network of advisors. I do have a very small request of all our participants and viewers today. I'd like to ask you to tell us what topics you would like us to cover in this webinar series. We really welcome your input on any professional development ideas you have, particularly for business advisors, and you can also email me directly. I want to make sure that we are covering the topics that you need, and the only way we can know that is by getting your feedback. So please do let us know what topics you'd like us to cover. Before we start today's topic, I'd like to outline the format for the session today and provide a very short update on BLP's activities. Firstly, I'd like to ask you to please keep your microphones and cameras on mute, as this helps to ensure a good connection. Please feel free, though, to ask questions throughout the webinar by using the chat box, and we will have an opportunity for questions at the end. If we run out of time, though, we'll make a note of any unanswered questions and email you afterwards. And we are recording the webinar today, so you can also access it afterwards if you need to recap on everything. It will be saved on the BLP website. So for those of you who aren't familiar with BLP yet, here's a quick rundown of what Business Link Pacific is all about and some of our recent achievements. So BLP is funded by the New Zealand government. It's a private sector development initiative and it's delivered by DT Global. We currently work in 6 countries: Cook Islands, Fiji, PNG, Samoa, Solomon Islands and Vanuatu. We work in partnership with chambers of commerce, also financial institutions and the private sector, to develop our network of business advisory service providers in the Pacific region. And we enable SMEs, small and medium-sized enterprises, to access advisors' services in our network through our searchable database. So the idea being that by having access to high-quality advisory services, that really helps businesses to grow so much more than when they are working in isolation without professional advice. So it's therefore really important that we quality check our advisors so businesses can be absolutely confident in the quality of the services they receive. So all BLP approved advisors go through our competency assessment process to ensure that they've got the experience and skills to provide really high quality advice. We then help SMEs to access our approved advisor services by providing subsidised rates through our subsidy scheme. And we also have some free online tools such as the Business Health Check and the Business Continuity Planner, and they help SMEs to think about how well their business is doing and identify risks and contingencies, etc. We also offer professional development and support to our network of advisors through our Business Advisor Development Program, for example, this webinar, another webinar series, a podcast series, and through direct customised support services. So that's a little bit about BLP. Since starting in 2018, BLP has subsidised over 500 businesses to access advice, and that support has really helped them to grow. They've also found our online tools very useful, and our advisory network now consists of over 100 advisory firms with over 150 individually approved advisors with various areas of technical expertise that can support business growth. So I'd now like to introduce you to Alice Numata-Leota. who is a partner in accounting firm Numata and Leota in Samoa. And they've been serving the business community there since 1992. Alice is a certified public accountant in both Samoa and Australia. She has 15 years of professional experience and she holds 2 master's degrees from Deakin University. She's also completed a bachelor's degree through the University of Waikato. So good to see, Alice, that you've been supporting both Australian and New Zealand universities. And talofa Alice, whawhatai lava. Thank you for joining us today. As I say, good to see you sharing the love between both countries' universities. Welcome along to the BLP webinar, and we really appreciate you sharing your knowledge and expertise with us today.
Talofa lava, Barbara, and hi to everyone. I'm very pleased to be a guest on this webinar to assist our SME members on how to interpret financial statements.
Oh, thank you. Thanks, Alice. It's good to have you on board. I know it's a really busy time of year, but no, great to have you on board. Alice, in today's webinar, you're going to take us through 3 key financial statements that are used to report on the financial performance of businesses and outline what the reports tell us. Now, of course, as I mentioned before, interpreting financial reports is not just the domain of business advisors and accountants. All people, like business owners, directors, board members, they need to be able to interpret financial reports and know what sorts of information to look for to be able to really assess whether a business is performing okay or not. So Alice is going to take us through these key reports, starting with the profit and loss, or the statement of financial performance, as it's also called. But firstly, though, I thought we'd just play this very short video by way of introduction. So let's give that a go. Oops, hang on a second. Let's see if we can get to that one.
The profit and loss statement, also known as the profit and loss statement, also known as the
having a bit of trouble getting to that. Hang on a second. Let me just give that another go. Okay.
The profit and loss statement, also known as the income statement, tracks the financial performance of a business over a given period of time. It includes all sources of profit and loss which are relevant to the business for that period. This includes items which are not shown in the cash flow statement, such as vehicles and machinery losing value over time. The income statement consists of 3 parts: revenues, expenses, and profits. First up is your revenue. This is the money your business earns from all sources before you pay expenses, taxes, and other bills. Your expenses. This is the money that you spend. Here you can see the cost of goods sold, also called cost of sales. It's the amount of money which it takes to make the product or service you're selling. There are also operating expenses, sometimes called overheads, which are the costs of running your business, such as rent, marketing, and so on. Then you have depreciation. This comes from assets in your business losing value over time. For instance, if you bought a truck today to help supply your goods, it's going to be worth a lot less in 5 years' time, and you have the inevitable taxes. Finally, your profits. Gross profit is found here. The higher your gross profit, the more money your business has to cover operating expenses and other expenses. Net profit is on the statement too and is sometimes called the bottom line. This is the money your business makes minus all its expenses, including tax. This is the quickest indicator of the health of your business. Learn how each dollar entering your business makes its way all the way down to the bottom line by exploring the strategic finance resources on business.govt.nz.
Okay, so that's a very quick overview of the profit and loss. So what are the key things we need to know about this report, Alice? Alice, are you there? I think you're on mute still.
Sorry, Barbara, I lost you there for a second.
Okay, all right. And actually, we haven't got your picture on, but might get you to just pop your picture up for a second. And I know your connection's not doing too well today. Oh, there you are. Hi.
Yes. Hi.
Fantastic.
The internet in the islands are not that great.
Yeah. Okay. So yeah. So what are the key things we need to know about the profit and loss report?
Well, as mentioned in the video, there's 3 parts to the financial, to the income statement or the statement of financial performance. And that's the revenue. It shows your revenue, what you make in the year, and what the business makes. It shows the expenses of the business and whether the business is making a profit or a loss. Now, it's important to note that the statement of profit and loss or income statement or financial performance is like 3 names to the same statement. It's important to know that it's prepared for a period of time. So it could be for a year or 12 months or 6 months. And also, it shows both cash and non-cash items, as mentioned in the video.
Okay. So so this is an example of a company, isn't it? Do you want to just talk us through this ABC Mart and explain a little bit about what their profit and loss looks like?
Yeah, so this part of the slide shows the overhead costs and then the net profit before after tax, but that's further down. So this part is like the trading account part. So it shows the operating revenue less cost of sales or the direct costs related to the sales activities. And then it shows the gross margin, and then you take away the direct costs, which are like direct, for example, direct wages, freight, transport, subcontractor costs, and then you get the gross profit. So the cost of sales refers to the production or purchase of inventory. And so basically all other direct costs relating to its services or purchase of inventory.
Right. So with that inventory, I see that it's got the opening and closing stock. Does that mean you've got to do a stock take at the end of the financial year?
Yes, it's important to carry out a fiscal stock take at the end of the financial year. So most businesses use an inventory system or a point of sale system, which tracks the inventory movement during the year. But this system reports, the only way to verify it is to actually take a stock take or a fiscal stock take. And then this will show any variances between the system report or the system figure for the inventory and the actual inventory you just did. So it's good to do both, to see any variances, pick up any variances between your system that you used during the year and the actual stock take that you did.
So what about any damaged or missing stock? How would you account for that?
You can write them off as damaged stock or theft, if you're being honest in the financial statement. You can write them all off. They're all part of, I wouldn't say normal, but they are part of some of the activities that businesses experience during a year. Damaged stock, theft, obsolete stock, things like that.
Right. And just looking at those numbers, it looks like the inventory levels are quite stable, like 28,500 at the opening into 2020, and then, 300 odd more at the end, and, not too different, I suppose, from the previous year. So I suppose, yeah, that's pretty stable. So tell me why, so talking about the direct costs and then overhead costs, which I think we're going to look at in the next slide, why is it important to separate out those direct costs from the overhead costs?
Okay, so it's important to know how much the business spends on its direct costs and its overhead costs. Now, as mentioned before, direct costs are driven by the sales activities, whereas the overhead costs, they're more like your fixed costs, and they're not driven by the level of activity. So for instance, overhead costs, for example, some costs of supported services, for example, rent, you still pay your rent regardless of how much inventory you sell during the year. So it's important to know the different type of costs that you're dealing with for your business.
Right. So I suppose the other way of looking at the direct costs is that they're kind of the variable costs, and as you said, the overheads are more the fixed costs. You're going to incur them anyway, whether you make a sale or not.
Yes, that's right.
Okay. So when I look at the gross profit, the gross margin in this business, it looks like, that's only about a 10% markup on the cost of sales. So I'm not quite sure what sort of business this is, but it looks to me like it's some sort of discount retailer, do you think? Like they rely on selling like high volumes because there's not much of a markup. What do you think? Do you think that's the sort of business it might be?
Yes, if you look at the gross margin, it's about 10% markup. So yes, it's a high volume given the number of sales is about 3.5 million, and given the purchases they make during the year, it's about 3.2 million. So it's definitely a high volume, low margin type retailer.
Right. Yeah. Okay. So let's have a look at the overheads. So here's some overheads in this report. Do you want to just talk us through those?
Okay, so these overheads, they're basically, like as mentioned before, your support services or fixed costs. So it consists of your bank charges, advertising costs, accounting fees, computer expenses, depreciation, directors fees. And so you take your gross profit less your overhead expenses, and that gives you your net profit before tax. And after you take away the tax, then you got your net profit after tax.
So that's what the business keeps for itself, huh?
Yes.
Yeah. So I see that depreciation's included in this report, and as I think they said in the video, it's a non-cash item. So what can you just explain what that is?
Okay, so any business, most businesses have fixed assets or what you call property, plant, and equipment. And to account for the use of these assets, so these assets are under the balance sheet. That's the next statement that we will come across. We will talk later on. So the use of this fixed assets is what you call depreciation, and this is the expense. So it basically accounts for the uses during the year. And this is a non-cash item, and it's accounted for under the profit and loss report.
Okay, so it's kind of saying, you've got an asset that serves your business for multiple years, and so you're counting a little bit of the cost towards that every year. Okay, yeah. That kind of makes sense. And I notice in here that there's wages for an administrator. But just flicking back onto the past, to the other sheet, we had direct wages, but the wages that we've got in the overhead section for the administrator are fixed wages, aren't they? So they're different to the direct costs. So this is somebody who's employed regardless of whether sales are made or not, I suppose.
Yes, that's probably relating to the administration of the office. Yeah. Whereas the wages they're directly related to the sales activities and the production of the goods and services for the business.
Okay. And I mean, we haven't got it in here, but if you had a loan, for example, and you incurred interest payments for that loan, that would be in the P&L as well, wouldn't it?
Yes. So a loan is a debt, so that's also under the balance sheet or the statement of financial position. But the interest expense portion of the loan repayment for that debt, it's an expense. And if there was a loan, it would go under the profit and loss report, the interest expense.
Right, but not the principal amount, huh?
No, the principal amount is offset against the debt amount under the balance sheet.
Right. So are there any other non-cash items that get included in the profit and loss?
Yeah, so there's sometimes you got your doubtful debts. Those are the debts that management deem irrecoverable or doubtful. So they can record it as doubtful debts or bad debts when you write it off. There's depreciation, as we discussed. There's also, if you decided to use a revaluation model, you could have a fair value, gain or loss, and there's also foreign exchange transaction. So all those go under profit and loss. If if you operate in a foreign exchange type, a multinational company and stuff like that in different countries.
Yeah. And I see that the last year's results are also put in there as a comparison. And that's always the case, isn't it?
Yes, it's always good to have the prior year figures or financial information so you could have a benchmark to compare if this year is improving or not, if you're doing worse off. So yes, it's always there. The variance column though, where you're showing the movements, if you can see that, that's not always part of the financial statements, but it's good to have if you want to illustrate the percentage movements for the...
I like that they've got it in red and green too. That really helps to see whether it's positive or negative.
Yeah.
Okay, so are there any rules of thumb or suggestions on what the relationship should be between your overhead expenses and your income?
There's no set rules, but most businesses try to make sure the pricing is 3 times the cost or 30%. That's because if you put the pricing 3 times, that means 1/3 will cover costs that you bought the goods for, and the other 1/3 will cover your overhead, and then the remaining percentage, which is 1/3 of 40, will be your profit that will help sustain the business moving forward. So yeah, it's not a rule of thumb, but most businesses tend to use that as a guide.
Okay, we lost you a little bit there, but I think you're kind of saying, 1/3 for cost of sales, 1/3 for overheads, and the 1/3 portion to be profit for the company. And we'll talk a little bit more about ratios later on. Oh, that's cool. So, so let's look at the balance sheet or the statement of financial position next. But first, let me have another go at playing a little video, see if it works a bit better this time. Okay.
The first step to understanding your finances is looking at the balance sheet and the cash flow statement. A balance sheet is a snapshot of your business's financial position at a particular time. It is divided into 3 parts: assets, liabilities, and equity. Assets are the items which add value to your business. Your balance sheet will show you what each asset is worth. Liabilities are money you owe or need to pay back to your lenders. Equity is the net worth of your business. It's the difference between the sum of your assets and the sum of your liabilities. If your equity is positive, it means that your liabilities are smaller than your total assets. If your equity is negative, though, it means that your total liabilities or debts are greater than the total sum of your assets. The question is, why is it called a balance sheet? What exactly is balancing here? Well, the idea here is that the total assets balance the total liabilities plus the equity. A cash flow statement is a summary of the cash transactions of your business over a certain period of time. It is kind of like checking your bank balance, but better because it allows you to identify patterns and problems. A cash flow statement is divided into 5 parts: cash flow from operations, cash flow from investing, cash flow from financing, closing cash balance, and net change in cash. After looking at these 2 statements, you should be able to understand the financial position of your business at any given time. You will be able to spot opportunities and risks. You will be able to identify what you have and what you owe. And you will be able to communicate this information to lenders and investors. For more information on balance sheets and cash flow, head to business.govt.nz.
Okay, so I'll hand back to you then, Alice, to explain a little bit more about the balance sheet or the statement of financial position.
Yeah, so the video mentions that it balances the assets, liabilities, and equity. So you can look at it as the source of funding, which is either from equity or your shareholding, or debt if you borrow from a bank to start your business, right? And from those funds, you buy your assets, like your fixed assets, your inventory, things like that. So it's basically balancing the two up. Your source of funds, which is debt and equity, and what you use those funds for, which is your your assets. Another important part of the report would be that it's prepared at a certain date, and that's what people would call the reporting date. For example, 31 December at end of the year, or its balance date. It's also prepared on an accrual basis, which means it includes both cash and non-cash items. So those are just some of the important key points of the balance sheet report.
Okay. So in this one, I see that there's current assets and then non-current assets. So what's the definition of a current asset versus a non-current asset? Is there a time factor that's involved? I mean, like, how quickly you can liquidize the asset, for example?
Yes. So to differentiate between the current and non-current, this depends on a time factor and the liquidity of the account. So current assets, they're assets that are expected to be converted to cash within 12 months or within a year. Non-current assets are those that are considered long-term, and their full value won't be recognized until at least a year, so they're more than a year. A good example is the property, plant, and equipment, or as most of us know as fixed assets, which is 5,348. Now, these are items usually includes building, land, plant and equipment like machinery, things like that. And those fixed assets, they're usually maintained by a business for more than 1 year. So that's why it's underneath classified as a non-current asset. Whereas inventory is classified as a current asset because inventory is mainly for reselling purposes, and for your business. You don't want to hold it more than a year. You want to sell it. You want to sell it regularly, like high inventory turnover. So it's classified as a current asset.
Okay, so yeah, more short term. Okay. So let's have a look at the liabilities. So what sorts of things are liabilities?
So liabilities are usually debts. So as you can see, you have your current liabilities, which has your payables. So those are your creditors. And then you have the GST, and that's the GST portion of your, your normal operation. You also have a shareholder advance account, and that's when you, say, for example, you borrow from the shareholder and you have to pay back. So it becomes an advance to the company. And then you have, sometimes you can have a bank loan if you have a term liability or a non-current liability, but in this case, there's no bank loan. Yeah, so those are the only liabilities being shown in this case example.
Okay, so I noticed that the GST is in here, but GST didn't feature in the profit and loss at all. Why was that?
Because GST is basically a tax that the company is collecting on behalf of the government or the Ministry of IRD. I'm not sure what New Zealand call it, but in some was called the Ministry of Customs and Revenue. So you're supposed to pay it back, and that's why it's a liability account.
Okay, so it's not actually part of your. It's not really part of your income or expenditure, isn't it? So it's not
yours.
Right. Okay. And so, can you clarify what equity actually is?
Equity is sometimes known as the shareholder's equity, and this is basically the net balance or residual value if you take away debt or liability from your total assets. Some people look at it as the net worth of your business. And some of the accounts so in this case, it's basically reserves, which is from prior year, and the current year earnings. And then there's a 500 paid in equity, and that must be the shareholders' capital. So those are the normal accounts that you will find under equity.
Okay, so If you were to use the financial reports to estimate the value of a business, how would you go about doing that?
So there are different approaches you can value a business. Sometimes you have an asset approach, income approach, but a very basic method that you can use is the net assets, which in this case you will find under the balance sheet, right? And you could take that and you could divide it by the shares you hold, and you'll find how much each share is worth just by, net assets divided by the total shareholding. Yeah.
Right. But of course, none of that takes into account what the market is prepared to pay for that business. So this is really purely on a book value basis, isn't it?
Yeah, that's right. This is mainly a book value or historical cost information. Sometimes the fixed assets you hold, they're worth a lot more, but because they were recorded at its cost or purchase price, it's not being accounted for, the value of that land or property right now. So
Right.
yes, yeah, it's good to find other methods that's more suitable, for your business and stuff like that.
Yeah, so it's only one indication, really, isn't it?
Yeah.
Okay, so the cash flow statement. So I'll get you to go on and explain the cash flow. They mentioned it in the video as well, of course, but perhaps if you could go over what's covered in the cash flow statement.
Yeah, sure. So the cash flow statement is basically a movement of cash, like the cash movement for the business from your opening balance in the beginning of the year to your ending balance at the end of the year. And it's all cash transactions only. There are no accrual or non-cash items. And it outlines 3 activities. The first one being operations or operating activity. And this is your normal core business activities. For instance, manufacturing, marketing, selling, your personnel or staff costs, payment to your suppliers, and so forth. Investing, or the second type of activity, that activity relates to long-term assets and other investments. So if your business is investing in a term deposit, that transaction will go under this investment activity. If you're investing in more machinery or fixed assets, that will also go under here, under your investment activity. The last activity is the financing activity. And this includes transactions involving source of financing for the business. So if you get a new bank loan during the year, which is a source of financing for your business, if you want to do an expansion and you get an additional loan, that transaction will be classified as a financing activity. So those are basically the 3 activities that you will find in a cash flow statement.
Right. Okay. So we'll look at an example for the company that we're looking at. I suppose the cash flow statement it's important, isn't it? Because cash is kind of like the blood circulating around the body. If you don't have enough cash, you can't pay your bills on time, even if your business is profitable.
That's right. Yeah, that's right. So as mentioned before, cash is quite important. And as you can see here, in this example here, they had a net increase in cash of 15,000 during the year. So the operations or operating activities are at the top, and they made a net cash inflow of 156,482, right? So the bulk of their net cash inflow was from their operations. And then they purchased 1,200 worth of fixed assets. And then the financing is shareholder is 140. So it's actually 156,000 minus the fixed assets purchase minus the 140,000, and then you get a net increase of 15,000 for the year. So yes,
it's quite low.
It's quite important to know what you're really spending on, all of the different activities of your business.
And so what are some of the impacts of poor cash flow on a business?
Okay. Well, like mentioned before, cash is king. So some of the impact of poor cash flow on a business include, For instance, opportunities. If you have poor cash flow, this may lead you to having to pass up on some great opportunities to grow your business. For instance, there's a machinery that you need to buy to increase your production, but now you can't afford it because you don't have the cash to pay for it. You have poor relationships with your suppliers. If you're always late with your payments to your suppliers, this may cause poor relationship with them moving forward, right? They might not want to deal with you later on. Poor relationships with your customers. If you're also contacting customers for overdue invoices and you're stressed out, and you're following up payments regularly, yeah, it may cause duress or stress over that relationship too. Employee morale, I mean, we all understand if you're not paying your employees on time, of course, you're not going to have happy employees working for you. The solvency, it could be a going concern problem for the business if you don't have the money to sustain your business moving forward. It also leads to restricted growth. You can't really expand if you don't have the money to expand, and you can't really get further debt or further financing if you don't have the money to pay those financing. So yes, it's poor cash flow can lead to quite a few unfortunate circumstance you don't want for your business.
That's all of those things sound pretty major to me. So cash flow is absolutely critical, isn't it? As I say, you can even have a profitable business, but with poor cash flow, and it can be the cash flow that actually turns your business insolvent. So yeah, very important.
Yeah.
Okay. Sorry.
No, I just wanted to add that this is the one statement that most banks will look at first. Because you can have a profit, but you don't have the cash in your account, or you're working from an overdraft, right? So they will look at this. Yeah.
Yeah. So you're not going to get a loan if you haven't got good cash flow.
No.
Yeah. And I see in here you've got that GST is outlined again, even though, as we mentioned before, it's not in the profit and loss, but still it's a cash payment, so it's there.
That's right.
Okay. All right. So what steps can a company take if they do have poor cash flow? What would you recommend they do to try and bring that under control?
Okay, so yes, so you could be proactive with your follow-up of your payments, with your debt collection. You can work on your aging receivables and see what are like overdue and are currently due, and you can follow up regularly. You could avoid late payments because they incur penalties and things like that. Number 3 is quite important. If you set a budget, you can actually control your costs, right? You could say don't spend, or tighten the controls over your no overtime to reduce wages, things like that. So you could actually set a budget to improve your cash flow and bring the business into a position that you could use the excess cash flow from this budget and use it for something that you want to use the cash flow on. And most importantly, you got to boost your revenue. You got to look at all opportunities that that comes with the business, and you want to increase your sales volume. And if the pricing is not right, you got to look into that increase of price also to cover all your costs. So those are some of the ways that you can do to improve your cash flow.
Yeah, no, that's great. Okay, so tell me, why do we read all of these reports together? And actually, can you get away with just having, say, the profit and loss in the balance sheet?
So all 3 statements are part of the required full set of financial statements for any business, and that's according to the standards of most countries, even New Zealand and Samoa. Asking to get rid of one is probably asking a builder not to do the kitchen while you're at it. So that's a must to have all 3. I mean, the balance sheet balances your assets, liabilities, and debts. And the profit and loss shows whether you're making a profit or a loss, what you make during the year, which is the revenue, and what your expenses are. Then the cash flow shows the movement of your cash during the whole year. So you need all three to help you make your decisions, to help you see if you, if you're doing well or not, the health check for your business.
Right. Yeah. So what about financial ratios? I know that there's lots that you can use, and we saw before in the profit and loss that there's a simple variance percentages that you could use as ratios, and they help you to sort of understand your performance. But what, in your view, what are the top financial ratios that you think a business should use?
Okay, so there's a lot of ratios, but the two that's really important in decision making is your profitability ratios and your liquidity ratios. So basically your profitability ratios include your net profit ratio or your return on assets or return on equity ratio. And your liquidity ratios are your current ratio or debt to asset ratio. There's a lot of ratios, but if you do your research, there's quite a few that will help you determine where you're at your business. Yes.
Okay, so those are the top two, profit and top two, liquidity. What do you think a good ratio figure would be for each of those?
If I was to base it on the pricing guideline that we talked about earlier, I would say at least 15% to 20% is a good net profit ratio for you to keep to sustain your business from year to year. I mean, anything above that would be great. Yeah.
Yeah.
For current ratio, you have to, so current ratio is your current assets less your current liabilities. So you need to cover it, like 1-to-1, that's break even. So you need to cover it. So it's like you need 2-to-1 ratio of current assets to current liabilities.
So double. Yeah.
Yeah, and the debt to asset ratio. Now that's how much of assets is being funded by debt. So you need to say at least 50%, because you don't want to be indebted like 80% to a bank, because then they can pull, the loan and everything, and you'll be stuck, So try to cover 50% debt and 50% by your shareholding, your own reserves or cash, instead of relying on an external party.
Yeah. Yeah. So no more than 50%. Okay. No more than half of it. Yeah. Okay. Now that sounds good. So, well, let's have a little look at how our company's doing with their ratios. So, their net profit ratio looks really low then, if you're saying that, you need it 15 or 20%. That's really low, isn't it? And I suppose that's because, they have that high gross profit in relation to the profit margin, which we looked at. That's the reason for that, isn't it?
Yeah. I think we agreed it was a low margin, high volume. So they only, I think it was 10%, if I'm correct. It was 10% the cross profit, cross margin that they were adding. So after the 10%, then they take away, it looks like roughly 8.5% of overhead.
Yeah.
Leaves them with a net profit ratio of only 1.5. Yeah.
So basically, they're handling all that money and all that operations, but they only make a really small amount of money. So there's quite a risk involved in that, I guess.
Yeah.
So then the return on assets, how well the company is using its assets. So they've got 31% return on their assets. So that's probably pretty good, isn't it?
Yeah, that's definitely good. Yeah, that's the return.
Yeah, sorry. I suppose another way of looking at it is instead of having bought those assets, you folded the company, invested the value of the assets in something else. Would you get the same sort of return? So would you get a 31% return on that money through another means? No, that's quite hard to achieve, I would imagine. So that's a good return.
Yes, that's very good. Same as the return on equity. Those are both good. And they return on assets improved compared to 2019. So that shows a good performance for 2020. Yeah.
So at the moment, I imagine, with COVID, there's some businesses that have got a very low return on their asset ratio, very low return on asset ratios, because they've got key assets that are sitting around doing nothing. So they might want to think about how they could redeploy some of those assets.
Yes. So in Samoa, we have a few, for example, hotels that are closed. So what they're doing is they're packing lunches and they're selling food. They're using their ovens, their kitchens, which is like commercial kitchens, and they're using it to sell prepackaged like catering lunches and stuff like that, to earn money from the assets they already have. We have another business also that's like a secondhand clothing store, and management noticed that the store is always filled with customers every time a new product or a new products are being displayed. So they're charging for the entry, for people to come in and have a look and then shop. So they're basically charging fees for people to be part of the first come and first serve. Yeah, so there's a few opportunities out there.
Oh, that's a great idea, because it's true, isn't it? When you're a customer of those stores, all the best things are picked over by the first people. So why not charge a fee? That's a great idea.
Yeah.
And I think about assets that aren't being used. Like there must be quite a lot in the tourism sector at the moment. The rooms are empty, so that those rooms are an asset. They're not being used. I know in New Zealand, the hotel rooms have been used as a quarantine facilities, so they're trying to utilise those assets in different ways, but often difficult to do that, I know. So just looking at those liquidity ratios with our little company here, that looks pretty good too. So they've got 4 times the value of the assets pretty much to liabilities. You said a rule of thumb is at least twice the value, so they're doing pretty well on that.
Yeah, that's quite good. Yeah.
And then the debt to asset is pretty low too. So again, you said lower than 50. It should be lower than 50%. So there's a 21.8. So that's quite interesting. I mean, yeah, we've learned quite a bit about this little company, I think, just from looking at its financial statements.
Yeah, the debt to asset ratio, if you go back to the balance sheet, you will see they didn't have a loan or a bank loan. So that's why it's quite low. They
Right.
have, yeah.
That makes sense. Okay. Oh, that's great. So, well, maybe we'll ask a few questions. If anybody's got any questions that they'd like to pose to Alice, now will be a good opportunity. Any questions?
Barbara, doesn't seem like there's any questions. Everybody's happy with the presentation. Oh, we have a question, Barbara.
Okay. Oh, sorry. Let me just have a look at that. Let me just get in there. Okay, so what's the difference? Hang on, I've just lost it. What's the difference between a cash flow? Oh, hang on a minute. What would you suggest? Would you suggest a business prepares a cash flow forecast? Okay, so we've been looking at the cash flow statement. This is about cash flow forecast.
Yeah, so the cash flow forecast is different from the financial statements that we just discussed in the webinar. That's because all the financial statements that we discussed, the cash flow, profit and loss, and balance sheet, they're all based on historical financial information, which is the past or current, whereas the forecast is actually a futuristic type statement. And of course, your accountant can also prepare that. But it's a different statement. It predicts the next, for example, next 6 months and next 12 months. And this basically, the banks usually ask for this. So they know you can service your loan over the next couple of years. So they'll ask for 1 to 2 years worth of forecast from you.
Right. Okay. So what's the difference then between the cash flow forecast and a budget?
Okay. So the budget is usually a document or a tool that you use to set an objective, like your revenue target goals, like you're targeting this much revenue to make in this year. And then you also target this much spending, to limit your spending. And then you get your targeted profit for that year. The cash flow forecast is not really a document for to achieve objectives, but they're mainly to say predict the next 12 months or 6 months, but they're based on actuals, right? You're not forcing it to be like high, like have a high sales or something, right? You're predicting it based on your actual financial information, right? Is it clear?
Yeah. So I kind of think of the budget as like your future profit and loss, and your cash flow forecast is the ins and outs of the money, including all of those non-operational items.
Yes. Yeah, that makes yes. And also the cash flow forecast doesn't include any targets for the year. They don't include any objectives for the company. They're just your focus for the next 12 months based on your actual. Hope I'm making sense, Barbara.
No, that makes sense to me. To me anyway. That's fantastic. Okay. Oh, thank you for that. Well, look, I'd just like to thank you, Alice, and thank you everyone for joining us in this webinar. It's been fantastic and really, really interesting to look in quite some detail about those financial reports. So thank you very much, Alice. Really appreciate you sharing your expertise and your wealth of knowledge on this subject. Now, our next webinar will be in a month's time on Thursday, the 10th of December, and it'll be the same time. That's 2 p.m. New Zealand time, and just bear in mind the time differences across the Pacific. Now, as I said earlier, this series is about supporting business advisors to develop the skills they need to provide high-quality services, and so we do invite you to tell us what topics you'd like us to cover. Please email me with any suggestions. My email is there on the slide at the moment. And don't hesitate to reach out to any of us at BLP at any stage if you need any support or advice. Whawhatai lava, thank you Tomas, Vinaka, Meitaki Maata, and I look forward to seeing you all again next month. Bye for now.
Thank you and goodbye.